And speaking of Carl Icahn, the activist investor announcing today that he's sold his stake in Netflix, calling the streaming TV space overheated. After spiking on news last night that it would split its shares 7-1, Netflix sold off slightly today. So do stock splits really matter for investors? Dominic Chu has the takeaway.
Stock splits don't happen all that often. There have only been 7 among S&P 500 stocks this year, and there were 11 last year. So, what exactly is a stock split and why do investors care? Simply put, a company takes each share of its stock and divides it into smaller pieces. For example, let's say you own 100 shares of stock, each worth $700 a share, meaning your holding is worth $70,000. Now the stock splits 7 for 1. You'd end up owning 700 shares, but each is now worth only $100 per share. Either way, your holdings are still worth the same $70,000.
Stock splits affect the company not one bit. In fact, as far as the fundamentals of the company, they remain exactly the same. Whether or not you want to invest in the company shouldn't change based on the number of shares that they just took from 1 million to 7 million, for instance, on a 1-for-7 split. Shouldn't change your investment thesis one bit.
A big reason why companies split their stock is to decrease the price of each individual share. Investors are given more shares to compensate for that. Some argue that it helps performance, but the evidence is mixed.
Apple's a great example of that, where they did a stock split and the stock performed quite well after that. But that isn't a guarantee, and believe it or not, Netflix is a great example of that. Last time they split didn't work out so well for the stock in the preceding 6 to 12 months.
That's why many professionals say that a stock split shouldn't be the sole reason to invest in a company.
I don't think traders should flock to a stock or investors just because of a stock split. Although empirical evidence shows that they do tend to drift higher, there's no guarantee of that. All you're doing is trading the same stock in greater volume than you did before.
The important takeaway when it comes to stock splits is that it has no effect on the fundamental business that a company engages in. It's just a mathematical maneuver to reduce the price of a stock without reducing the total market value of the entire company. For Nightly Business Report, I'm Dominic Chu.